Hi, everyone. Welcome to this episode of the EUVC Podcast. Today, I have Kristaps Ronis with us. Kristaps has a very interesting profile, mixed between global and European focus in this episode. So it's going to be kind of an interesting one. So please stay tuned. Kristaps is a partner at Ion Pacific. Ion Pacific is, and we'll talk all about them in detail, so I'll be quite brief about it. But they're actually right now raising their fund 3. They're still deploying, so they're actively investing in the market. So if anything here is interesting, you can definitely reach out to them. Their AUM is approximately 550 million euros, roughly here, with rounding ups and FX and whatnot. They're HQ'd in the US, in LA. They do have a very strong European presence in Switzerland. I consider that Europe, by the way, and also in Asia, Hong Kong. They're really focused on Series B+, so BCD, tech companies, global portfolios, everything we love. They invest in the US, North America, of course, Europe, obviously, that's why we're here, Israel, Southeast Asia, etc., etc. But generally, I think the core message here is Ion Pacific is a tech generalist, but really nailing down on that B2B software and fintech space.
Before we start the show, a quick note. If you're building or running a fund, you know it takes the right partners. At EUVC, we only work with sponsors we truly believe should be part of your tech stack. Please do take a moment to hear about them. And if you do, reach out, mention EUVC. It's the best way you can support what we do. Thank you so much. First up, Ace Alternatives. Every fund manager needs clean operations behind the scenes. From fund admin to tax and compliance, Ace handles it all across VC, PE, private debt, and real assets. They're trusted by some of the best investors in the world, and if you want peace of mind and a scale-ready back office, Ace should be part of your stack. Finding deals and managing your portfolio is at the heart of running a fund. Synaptic helps you discover status before others do, and Portfolio IQ keeps your portfolio data sharp and ready for LPs. Together, they're essential tools for modern fund managers. When it comes to legal, you need a team that truly knows venture. Haynes Boone supports LPs, GPs, startups, and scale-ups across the full fund lifecycle. Smart managers make Haynes Boone part of their stack. We have two at EUVC. Tech Barbecue. Oh my God, who doesn't love barbecue? Europe's startup scene meets the loudest, friendliest family reunion ever at Tech Barbecue. From Nordic founders to global VCs, this is where ideas catch fire and relationships get real. If you're building or backing in Europe, Tech Barbecue is where you want to show up. And hey, if you've got a big fun announcement coming up, want to hit the headlines, or just want to tell your story out, do reach out to us because we'd love to help. And we've got some killer partners to help you get in the right media places. They've helped us land Bloomberg, CNBC, Financial Times, Forbes, and many more for the EUVC Summit, and we'd love to do the same for you.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
Kristaps, I could say quite a bit more about you by reading my notes here, but I think it's better to just reel you in, say welcome. What would you like to say, like quick one-liner or a couple of liners about you and Ion for people joining in right now?
Absolutely, and thanks, David, for having me here. What I would say, I'm Kristaps Ronis. I'm a partner at Ion Pacific. We are a global investor, as you rightly pointed out, focused solely on providing liquidity to the venture ecosystem through structured investments and secondary investments. I run our European practice and oversee most of our European transactions, both on the portfolio levels as well as single company transactions.
Their model is maybe different from some of the secondaries models and episodes we've done so far. And so that's why this episode is being marketed under this topic of structured secondaries. We'll get there in a minute. Let's start as we always do. Kristaps, how did you end up where you are today? Give us a quick flavor of who are you, what have you been up to, and what got you into this, I like to call it the wonderful world of venture.
The wonderful world of venture, exactly. So, look, David, I was born and raised in Latvia, started my career there as well. In finance in a relatively standard way. I was a foreign exchange analyst up to a point when I decided I completely wanted to change the trajectory of my life. Moved to mainland China for 2 years. I was doing a full-time program at Peking University. They have a wonderful finance program there. And I was living in Shenzhen, in a very rapidly developing city in the south of China. And that gave me a fantastic perspective on life, on finance and business, and on how quickly this world is developing overall. After my 2 years in China, I didn't want to leave the region. I moved to Hong Kong, started my career in investment and merchant banking. Again, a pretty standard way to continue after a master's studies. Not long after me starting my stint there, the bank was acquired, and the two co-founders of Ion Pacific, who are back then the co-heads of investment and merchant banking, invited me to start a new firm together with them, and that was Ion Pacific. So fast forward 10 years, we're a global investor with 3 offices across Asia, Europe, and the United States. We're one of the leaders in the venture secondaries and structured secondaries in particular. And I became a partner a few years ago and oversee our European operations.
So before we go on with the usual flow of our episode, structured secondaries, right? So that's probably going to be, I don't know, I haven't decided yet, but it's probably going to be on the title of this podcast once it goes out, right? Want to give us the quick, very brief kind of teaser? What does that mean so that our listeners can decide, I'm going to stay tuned in or not?
Absolutely. So on structured secondaries, we all know what a regular way secondary transaction is. There's a buyer and there's a seller of shares or of a portfolio. But what we oftentimes see in the market, there are a couple of things that happen. Number one, owners of assets don't generally want to sell their best assets in the secondary market. Number two, they have very different views on the value and pricing of those assets versus the secondary buyers. And last but not least, oftentimes owners of these assets do not want to be seen in the market as sellers. And that is exactly where a structured secondary transaction comes in, where without purchasing the asset and taking over full control of the asset, we are able to provide partial liquidity to the current asset owner and engage in an agreement on splitting future cash flows from that asset. Therefore, they're not selling the asset, they're getting upfront liquidity, and they're getting future upside from the same asset.
Yeah. Okay, we're going to dive deep into that. So if that's interesting, stay tuned. Before we get there, our standard question as well. Almost every single one of our, I think it's now almost 600 guests have answered this, if not more. Biggest learnings in venture, Kristaps. What have they been?
I think number one, it's the absolute paradox in venture capital that is really fascinating, where the industry as a whole is full of the brightest minds out there, solving the most complicated and innovative problems out there, building technological breakthroughs in a very creative way. That being said, the financial innovation in this industry hasn't fully kept up with the pace of innovation, right? The top 3 instruments that are still available to the venture world are common equity, preferred equity, and a bit of venture debt. And if you compare that to any other asset class, any other sector where you have very strong presence of derivatives, structured credit, various hybrid instruments that help to manage liquidity, manage risk, venture has really lagged behind. And that's one definitely learning that I had. And that's something that we at Ion Pacific are working hard towards, because I see a big opportunity there in bringing these various liquidity solutions and creative financial instruments into the world of venture.
Do you have any thoughts around why that's the case, if at all? In the sense of like, why do you think, you gave some very concrete examples, right? Derivatives, structured solutions, etc. Why it's the case we don't really see it that much in venture? Because we see it in private equity, our older brother, as I'd call it.
Yes, absolutely. I think one of the reasons why we don't see these more sophisticated instruments in the world of venture is that the underlying companies in these portfolios are in many cases pre-revenue, in many cases pre-product. And it takes a certain kind of skill set and knowledge about the industry and the types of underlying assets to be able to comfortably structure and underwrite these various types of instruments in this asset class.
Yeah. So kind of what you're saying in other terms, there is a limit. I'm putting words in your mouth, which is always dangerous. There's a limit to the level of complexity we can do, especially at the early stages, which changes as we move on. And here to talk a bit about what you guys do, right? B plus, right? Okay, now we're getting to a point where these things start making sense. And your point being, well, still there, we don't see it that much.
Yeah, absolutely. Still, we don't see it that much. And yes, definitely, Series B plus, Series C, we are starting to see some innovation, but definitely not in the earlier stages.
Okay, let's move on to your second learning, which I think the topic of more complex capital structures is something that we can focus it around.
Absolutely. So that's the other end of the spectrum, right? So overcomplicating things at later stage, and I think you put it really nicely in one of the other episodes. It being complex capital structures is a silent killer of some of these companies, right? So when a company raises capital, particularly in a very competitive environment, they are oftentimes pushed to maximize valuation, pushed to maximize round size, and incentivized to take on massive amounts of debt, which in the short run sounds great because you're extending the runway, you're opening up a wide array of opportunities for the company, such as M&A opportunities and so on. But over time, if you layer over these various instruments on top of each other, you end up with a cap table that is very complicated to navigate, almost impossible to navigate. And that creates strange incentives for these various participants. And the problem is, when the market slows down, you can see these capital structures and excessive amounts of debt really strangle these businesses and bring them to a point where they need to do restructurings, recapitalizations, pay-to-play rounds. And we've seen this more than enough, right? In some public cases, such as Getir or Refux, and many, many more happening behind closed doors.
Love your take on something. It's something I think about every now and then, and even today, this morning, I'm part of this WhatsApp group, which has a bunch of mostly I would say that most of them fall in the bucket of high net worths who do a bit of venture. My playbook, as someone who loves venture and studies venture, but I'm not a fund manager, right? I'm not meeting startups and running an investment shop every single day. So my playbook is quite simple. I love the early stages. I think that's where you can really get the outsized returns. For anything else but outsized returns, I just go into public market investing, like keep it simple, super plain vanilla, right? So my playbook is I'd rather have my money at work into funds because I can scale that without spending too much time, and I can meet everyone or almost everyone in Europe quite quickly, and then over time that compounds, and I'm able to actually have quite good performance. But a topic that I find myself having a hard time answering, and this morning was the same case. Obviously, there's a lot of dispersion in early stage venture, even when you invest into funds, as we all know. And so oftentimes I see the answer to that being, no, but do slightly later stage. Just do slightly later stage. And, my question to you being, here you mentioned that the complexity of these deals adds a new layer, right? In the sense that in early stage, we don't really have this. So when you meet, if you meet people like myself, right? So people who love venture, not necessarily fund managers, their day-to-day business is not picking investments per se, but they want exposure to, let's call it again, our wonderful world of venture. How do you think they should think about it? Would you dare say anything? Because this late stage conversation, I hear it a lot in this profile of individuals, and I always struggle to have a strong opinion there.
It always depends on your intentions and objectives, right? If you're looking for capital preservation, you typically don't invest in venture. If you're looking to make outsized returns, then I would say it really boils down to a couple of things, right? rounded out portfolio and a bit of diversification, right? You want to get some of those early stage names. You want to catch them early through some early stage funds. You want to continue supporting them through the mid and growth stage, and maybe you're even able to put together enough capital to put some money into a late stage pre-IPO fund, and that's one way to capture the whole value chain. The other option is obviously fund of funds, right? Where you get a much more diversified exposure to venture. And the last option would be also secondaries, which provides exposure to venture in a very diversified way, but with a shorter J curve and shorter time to liquidity as well.
This is when you see Kristaps is running an institutional firm, because he was very polished in his reply, which I appreciate. Final learning, which is a good way to wrap up this section.
Final learning, DPI is king, right? Distributions, real cash on cash distributions is what everyone is looking for in this day and age. Previously, it was different when in 2019 to 2021, the venture was only going in one direction, up and to the right. You could buy into the quote unquote market and still write a good amount of paper returns. But the tides have turned. Liquidity has been scarce. IPO markets have been closed. And the lack of liquidity and the lack of distributions is really impacting all and every ecosystem member. And therefore, DPI is king, cash is king, and the existence of many of the venture firms, the existence of many of the tech companies really relies on the flywheel of liquidity continuing to spin.
And you've just set the stage for the secondaries conversation, right? Because this is the I'm not going to say it's the ethos of any secondaries player, but it's very close to it. So secondaries has been getting a lot of attention lately, right? Of course, the DPI conversation being the reasoning for it. But I think it's safe to say, you guys, as an example, right? You guys have been around since 2015. So let's start with that. In the last 10 years or so, roughly, right? What have you seen change, right? In terms of the secondaries market?
Yeah. First and foremost, I would say it's awareness. Awareness that these instruments are available in the market and they can be used to achieve a variety of goals for the various ecosystem players, the GPs, the LPs, and the founders, right? So number one, people have become aware that we've all seen private equity players doing secondary transactions for the past 40, 50 years. However, in venture, these deals only started appearing post-2000 and more actively post-2015, right? Number two, it is the types of actors that are looking for liquidity. When the market was really strong and liquidity was not an issue and IPO markets were open, I would say 2016 through 2021, we saw a lot of single company deals, opportunistic transactions, sellers opportunistically looking to exit some of their holdings, and a lot of founder liquidity solutions, right? Because founders always do the most work and get paid last, so they're always in constant need of liquidity. Now, what we're seeing post 2022 in the US and post 2024 in Europe, it's really a big focus on fund level transactions. Funds have come to realize that they need to generate that DPI to keep their LPs happy and to keep the lights on. And therefore, that's a substantial change. And number three, we're also very happy to see more and more secondary and dedicated secondary players popping up on the map and evangelizing the same narrative that we've been evangelizing for the past 10 years, that secondaries can be used in a smart way to benefit everyone in the ecosystem.
You also had some notes around continuation vehicles, which we haven't touched on. I'd love to hear you comment on that as well, because I'm quite young in the industry, I like to say. I've been in it for a while now, but still, I think I'm quite young. And it's a topic I've heard a lot about, but I haven't gotten a lot of exposure to. So I'd love to hear your take there.
Absolutely. And what I can say is, historically, GP-led transactions such as continuation vehicles and other portfolio deals have been about 50% of what we do, the other 50 being single company transactions. Now in 2025, especially in Europe, about 70 to 80% of the deals that we see in Europe are portfolio level deals and especially continuation vehicles, right?
So
That's what
just to be clear here, we're talking about deal flow, not the deals you guys end up doing, correct?
both actually.
Okay.
Both actually. Deal flow that we see in the market, as well as deals that we're actively executing and have executed since the beginning of the year. There's a big focus on portfolio level transactions, especially here in Europe. I call it jokingly among friends, 2025 being the year of the European continuation vehicles. The $260 million Lakestar continuation vehicle that was announced last week, I think, is just tip of the iceberg when it comes to the overall market activity. We're seeing more and more GPs trying to close transactions, coming to market from the summer break through this instrument, and generating liquidity that way.
We've done quite a few podcast episodes on let's call it the most common or commonly discussed secondary type, which is company secondaries. We've spoken a tiny bit about fund or let's call it GP level secondaries, right? Whatever that means specifically. We haven't spoken at all on this podcast around the structured solutions. And you gave us a bit of a one-liner in the beginning. So tell us a bit about what do those deals look like, and feel free to share a bit of meat there as well in terms of why the need for these specific solutions from a buyer and seller perspective, right? Because I think that's super interesting for us to better understand, especially as you have said, it's something that we're starting to see more in Europe. So probably many haven't really seen these deals happen yet.
Yeah, so what we're seeing is a lot of GPs coming to market looking to generate DPI and figuring out the best way to do this between regular way secondary sales of portfolio companies, strip sales, continuation vehicles, etc. We're also seeing a bunch of situations where a structured solution could be more appropriate. For example, situations where the GP needs to deliver liquidity to their LPs because the LPs are demanding it, but they feel like selling an asset or assets from their portfolio could be quite premature. They would be leaving a lot of value on the table. Number two, around these more promising assets in the portfolio, they feel like the market isn't pricing them right, and the price that they might get in regular way secondary market doesn't really represent the expectations that they have for these assets. Number three, what we're also seeing, and that applies to both venture capital managers as well as corporate venture capital managers, they enter these assets, promise these founders, long and happy marriages with their companies, but now it's time to potentially part ways. They want to generate liquidity from these assets, but they don't want to be seen as a seller in the market. And therefore, what we're bringing in to the venture world is a structured secondary solution where we come in, we look at a portfolio, and we're able to provide a partial liquidity to the GP that they can distribute to their LPs without them selling any of the assets to us, without handing over any of the assets to us. So it's, I would say, a discrete and bilateral conversation that we have and the bilateral agreement that we enter where we provide partial liquidity and we split future distributions from this asset base where they have the opportunity to get partial liquidity now and participate in the ongoing upside while continuing to manage the portfolio from the same vehicle where it's currently held.
Yeah. So you're saying that the structured approach solves something that the unstructured secondaries can't really do, which is preserving upside, preserving control, and signaling the market the right way, right? So the thing about the seller not really wanting the market to know, sounds a bit too good to be true. What's the catch, Kristaps?
What is the catch? I think it takes a bit of a sophisticated GP to really understand the strengths and benefits of this structure in how to explain it to their LPs. Because if I'm saying, David, I'm coming to you and buying this asset at 85 cents a dollar, that's a very easy explanation. My LPs will get 85 cents on every dollar of NAV, and it's a very simple structure. But now I say, hey, what we're going to do is we will provide you with 50% of value up front, and then from now on, you will get 50% of the upside. There's a bit of uncertainty. Wow, I'm getting only half of the value now. And there's a bit of an uncertainty element as to the timing and the amount of future cash flows. So the GP has to have a strong belief in the upside of the portfolio in order to enter this type of transaction. And it takes a bit of LP education on that front as well.
Any words of advice if I'm either a GP listening to this, my fund is on year 6 as an example, which is a weird time. It's a tough time I find oftentimes to do any type of secondary. It's a bit too early, in some cases at least. But if I'm a GP listening to this, I find this interesting. What would your advice be to this persona in opening up this conversation also with their LP base and even maybe within the team, right? Of course. And then also the flip side question. I'm an LP in a fund. I'm kind of wishing there was some kind of liquidity now. Advice on opening up that conversation with the GP in case.
Let's start off with one stat that we recently looked up on PitchBook. We were looking at 2014 vintage, right? 10 years ago. The median DPI for that vintage is 0.96. So LPs have been locked into a 2014 fund, and they've barely made their money back, let alone making that outsized return that we're all waiting for. So I think starting these conversations from the LP side are exceptionally easy. David, where is my money? And from the GP side, I think it's very similar. Look, guys, we started this fund a while ago. We were hoping for a 2024 IPO for the key assets, then a 2025 IPO for the key assets. Now it looks like it might be 26 or 27. We're going to be running into end of fund life issues, and we need to think about how we appropriately manage liquidity and DPI. Also, knowing very well that we'll need to raise a subsequent fund in the future, and we want a substantial amount of re-ups from our existing LPs. That's typically how these conversations start internally. They're very practical in nature.
There was a small detail hidden in your notes around the structured alternatives being easier to negotiate when there's higher bid-ask spreads, which I thought is really very concrete, very specific, and very interesting. I hadn't thought about it. Why is it the case?
Absolutely. Right. So, and it comes into play in a broad range of situations. The most typical one is when the company has last raised in 2020 or 2021, say at a $2 billion valuation. And we now strongly believe that the fair value is closer to 600 million. But the manager is still valuing it at 2 billion, right? So we come in with our offer, which is essentially 30 cents on the dollar, not entirely palatable to the GP, not at all palatable to the LPs that still strongly believe, by the way, the assets are valued at 2 billion. Structured solution helps us a lot in this type of situation because we can say, hey, how about we pay you a proportion of what we believe it's worth, and your LPs receive partial liquidity, but you will receive a significant portion of the future upside. So that allows us to unlock that sticking point between us, the GP, and the LP around the missing liquidity. It allows us to invest at an entry point that is comfortable for us. And it also saves the face for the GP in their conversations with the LPs, to be frank.
Is the market at a point where when you guys do these deals, you have other co-investors, or do you end up having to take the whole deal yourselves?
More and more, and we're really happy about this. We're seeing deal partners and co-investors in transactions. And that being said, those are typically the unstructured deals, continuation vehicles, asset purchases. In structured deals, fund recapitalizations or strip recaps, It's generally us having bilateral conversations and us doing these transactions.
I guess that means there's potentially a segment of deals that are missed in a way because it's just they might be too big or on the other end of the spectrum too small because you guys have a specific sweet spot with your own like fund size and strategy, blah blah. Do you feel that already?
I would say so. In fact, I would say that we are the ones filling the biggest gap in the market right now because, you have the Harbor Vests and Stepstones playing typically in the 100 million or 150 million plus range. And it doesn't leave a lot of capital available to the guys, say in Germany, who are running a 40 million euro fund. And now in year 7, they want to do a liquidity solution around that. They just don't qualify for the minimum ticket for some of these larger private equity secondary players. Whereas us, we can happily fill that gap. There are also obviously much, much smaller deals that we sometimes aren't able to fill as well.
Yeah. Is that an opportunity for someone to grab, do you think? Or is it too small?
Potentially, let me put it this way. Regular way secondaries, I don't think there's a real size limit on the minimum side. For structured secondaries, there is, just given the structuring and legal work that goes into these transactions, where we feel like maybe a 5 million transaction is the minimum threshold that someone would do.
I have it written here, and I can't recall if I found this somewhere, if you told it to me first time we chatted, or if it's just my AI assistant hallucinating. So tell me if this number rings a bell. I have here that 40% of sellers in 2024 are first time sellers in terms of secondaries. Is that a stat that rings a bell to you? Does that make sense?
I think it's substantially higher, especially in Europe. When it comes to venture GPs in Europe selling secondary stakes for the first time, for many of them, they still need to go through this education process with us and understand what that means. So 40% is still on the lower end of the range.
Conservative
I would argue that it's substantially higher.
So based on Iron Pacific's experience and some of the data I found, I think we can both agree that roughly half, if not more, of the sellers in Europe are first-time sellers. And so that begs the question, what are the biggest mistakes sellers are making?
I think there are several things that we need to, that sellers need to avoid and need to think about. First things first, I would say, is the timing. Always the most important aspect for any transaction, but also secondary transactions. You want to enter the situation from a position of strength, not from a position of distress. You want to start thinking about a secondary deal way before you're running out of fund life, or way before you've run into issues in raising a subsequent fund because you haven't shown enough distributions from the previous vehicle. That would be number one.
Can I just pause you there? Like in terms of, sticking with timings, right? Rule of thumb, and this is a super dangerous thing to answer, I know, but rule of thumb, what's the timeline of a deal like this? What would you say?
Look, I think for us to come into a situation that's perfectly laid up for a secondary deal, we can wrap up the deal within 4 to 8 weeks. No issue at all. That being said, there are some preparations and homework that the GP optimally does before engaging with any secondary players. That takes time. So what I would say, definitely, if you're running a 10 plus 2 year fund, don't start thinking about these solutions in year 11. That's probably too late. Or if you're relying on re-ups from your existing LPs for your subsequent fund, don't start thinking about a secondary process only when you've heard 50 no's on your new fund because you don't have sufficient DPI. That can be avoided by starting 9 months earlier.
Okay, so rule of thumb, 6-9 months. That's exactly. Kind of what I get out of it.
Exactly.
Yeah. So next one, that's timing. That covers timing.
Yeah. Next one is definitely portfolio curation and preparation, right? Deciding on which of your assets are relevant for a secondary transaction and why. You don't want to offer up a bunch of pre-revenue, pre-product names that just won't be a good fit for the buyer. The second thing is making sure that you have sufficient amount of information. We see it way too frequently that we engage with seed and pre-seed managers. They've made investments 10 years ago, have lost access to all information rights, and then are really struggling to offload their secondary positions to the market simply because they don't have basic things like business plan, latest financial updates, cap table, shareholders agreement. All of that needs to be in place for the key companies before starting the process. And then lastly, I think that's sort of for more influential and larger investors. If you have the ability to clean up the cap table a little bit before the transaction, make sure that the businesses don't have weird capital structures or excessive amount of debt. That would be ideal, cleaning that up way ahead of a secondary transaction.
You finished with that topic, which I was thinking of how to ask it, because I think it's a tiny bit of a controversial question here, but it feels like many of the GPs, and I'll preface it by saying many of the GPs I love, which are emerging managers, they're a bit of in a tough spot because they tend not to have big stakes in these companies. Many of them, there's definitely different schools of thought, but if you just look at the volume of them in the market, at least in Europe, many of them aren't really lead investors. They're kind of just tagging along some kind of lead investor. So do you think that we're in a situation, or the market has led us to a situation, or whatever we call it, where emerging managers are kind of, I don't know, they're not really in a good position to be able to get these deals moving, or are they?
Yes, but I have worked with many very thoughtful emerging managers who negotiate at least a minimum amount of information rights and access to founder at the get-go. As a minimum, they maintain a great relationship with the founder so that in case a transaction like this comes across their horizon, they're able to re-engage with the founder and under any kind of standard confidentiality obligations, get access to that information. And we have been in cases where, theoretically they shouldn't have access to info, but managers successfully re-engage with the founding teams and get access to information and are able to execute on these deals.
Yeah, but that's good news, right? That's good news because many of these emerging managers, the relational side is very much in line with what they use as their value prop or their differentiation in a way, right, in the market. So that's very much aligned with that. So that's the good news, I guess.
Absolutely, I think they shouldn't let their heads down. If they don't have these rights according to the shareholders agreement, they can always go and ask and see what's available.
Okay, so mistake 1, timing. Mistake 2, portfolio prep. Is there a third one?
Third one is also a big one. It's the actual ability to close a transaction. And it has two sides to it. One of them is portfolio side, right? You want to make sure that you're able to transact on the assets that you're promising you're able to transact. We've seen a couple of cases in our practice as well where you agree on a 10 asset continuation vehicle, but the GP then comes back and says, sorry, I'm only able to transact on 7 of these because there's a ROFR or preemption right or something else prohibiting me to transferring this over to you guys. So that's one thing, right? So making sure that there are no governance related matters that aren't taken care of. And then the other side of it is LP communications, something that we discussed earlier in the episode, right? A biggest mistake is not engaging with their LPs early on, informing them of the intention of doing a transaction like this, discussing what the timeline could look like, what the structure could look like, what the impact on the LP could be. I think the last thing LPs need is being forced into a situation where they feel like I have no other choice but to either sell or roll into this new vehicle. That would be something that top mistakes that GPs make in the process.
Yeah. Okay, so now we're at a time in our episode where I feel obliged to say this. If you're still listening, is because you're really interested in this topic. And so Kristaps and I have been discussing and entertaining the idea of maybe doing one of our now somewhat established masterclasses. So we've done quite a few on different topics. We've been discussing the idea of doing one on secondaries, whether or not it's focused only on structured secondaries or GP-led secondaries, all of the above, etc. We've done one on direct secondaries into companies, so that's why I don't mention that one. So if you think that's interesting, drop us a line, either me or Kristaps directly. My email is very easy, david@eu.vc. Kristaps is probably very easy to find on High Pacific's email, I would guess, as they are today, and also quite responsive on LinkedIn, I would say. That's how we started talking, by the way. So if you think that's cool, drop us a line. And specifically, if you think that's cool with a specific angle, tell us, because then we can definitely design it more in line with what you're thinking. And to everyone else who's listening in and interested but shy to reach out, we'll inform you when we work on it, so you'll get that information. Kristaps, we don't have much time, so I want to cover probably my favorite kind of wrap-up question, because it's more about you as an individual than venture necessarily. And that is, what's the last book that you read that has truly inspired you?
I thought about this for a while, and I think there are 3 books on a regular rotation that I tend to reread every now and then. The first one is Keller and Papasan, The One Thing, which is traditional self-development and identifying the right priorities and focusing on one thing at a time and achieving this domino effect that allows you to achieve efficient outcomes and really outsized goals. So that'll be number 1. Number 2 would be Getting to Neutral by Trevor Moawad, which is a great book on developing a more neutral mindset and minimizing emotional responses to external impacts. And the last one that I was really impressed by and recommended a lot to specifically solo GPs who are looking to expand their practice is Dan Martell's Buy Back Your Time, on building support systems around you that allow you to focus on your key talents and your key value add, and everything else is taken care of. And that way you can really scale as a professional and really scale as an entrepreneur. So those would be my top 3.
Kristaps, any final words before we wrap this up you'd like to leave our listeners with? If they want to reach out, what's the best way to get in touch with you?
Absolutely. First of all, David, thanks for having me today. Second of all, it's always fun and exciting to talk about venture and secondaries. So if you have any questions and anything that we discussed today, feel free to reach out. If you feel like you're thinking about potentially a secondary transaction or just want a sounding board, very happy to be that sounding board. You can find me as Kristaps Ronis on LinkedIn, as well as kristaps@unpacific.com by email. Always very welcome to reach out.
Amazing. Thank you, Kristaps. Everyone else, thank you for joining. Thank you for tuning in. If you enjoyed this episode, you know what to do. Drop us a review, follow the pod, and subscribe at eu.vc.
Before we start the show, a quick note. If you're building or running a fund, you know it takes the right partners. At EUVC, we only work with sponsors we truly believe should be part of your tech stack. Please do take a moment to hear about them. And if you do, reach out, mention EUVC. It's the best way you can support what we do. Thank you so much. First up, Ace Alternatives. Every fund manager needs clean operations behind the scenes. From fund admin to tax and compliance, Ace handles it all across VC, PE, private debt, and real assets. They're trusted by some of the best investors in the world, and if you want peace of mind and a scale-ready back office, Ace should be part of your stack. Finding deals and managing your portfolio is at the heart of running a fund. Synaptic helps you discover status before others do, and Portfolio IQ keeps your portfolio data sharp and ready for LPs. Together, they're essential tools for modern fund managers. When it comes to legal, you need a team that truly knows venture. Haynes Boone supports LPs, GPs, startups, and scale-ups across the full fund lifecycle. Smart managers make Haynes Boone part of their stack. We have 2 at EUVC. Tech Barbecue. Oh my God, who doesn't love barbecue? Europe's startup scene meets the loudest, friendliest family reunion ever at Tech Barbecue. From Nordic founders to global VCs, this is where ideas catch fire and relationships get real. If you're building or backing in Europe, Tech Barbecue is where you want to show up. And hey, if you've got a big fun announcement coming up, want to hit the headlines, or just want to tell your story out, do reach out to us because we'd love to help. And we've got some killer partners to help you get in the right media places. They've helped us land Bloomberg, CNBC, Financial Times, Forbes, and many more for the EUVC Summit, and we'd love to do the same for you.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.